Dennis Bacon with Beyond Wealth Advisors. I'm the Chief Investment Officer here at the firm. And today we wanted to talk with you a little bit about year-end tax planning. 2020, as we know, has been a very unique year in a lot of regards, particularly with some of the tax areas we may not be aware of relative to the CARES Act that came out earlier this year, as well as normal year-end tax planning issues. The first issue I wanted to talk with you about was your required minimum distributions on your IRAs. For those of you who are over 70 and a half, that typically is an item that you're addressing this time of year. Well, with the CARES Act this year, we no longer have to do the required minimum distribution for 2020. Also, another change is if you have not turned 70 and a half before April 1st of this year, then you have until age 72 to begin your required minimum distributions. So those of you who fall in that year and a half window, it's a nice benefit for you. You may not even have to take any in 2021. That's probably one of the big things that I think will apply to a lot of our older clients. The other thing that I think is important that we look at for this year, because of all the volatility in the market, we need to look at our capital gains situation. A lot of clients early in the year rebalance their portfolios, did activity to capture losses early in the year, which means they may have a lot of losses going into the year. If you were not able to do that early in the year, you need to be aware that a lot of mutual funds this year are going to have larger than normal distributions from their portfolios. This will cause some tax impact in your non-IRA money. So make sure you're aware of that, and if you have any capital losses that you can take for things that still haven't recovered, you may think about repositioning those into similar assets if you want to remain at that same risk level, but capture the losses now so it can minimize your tax impact for 2020. A couple of other things that you need to be aware of as you go into the end of the year. There are more traditional things we need to look at. If you are on Medicare, you know that you have some income limits that will cause your premium to go up. If you're single, you want to make sure your MAGI, which is your adjusted gross income number that they have, that includes all your income, including your non-taxable income and a variety of other things. If you're single, you want to make sure that number stays under $87,000 a year. If you're married, we need to keep it under $174,000. This will kind of minimize your cost of that for 2021, so be aware of that as you move forward. The other thing that we typically look at this time of year is your retirement contributions. If you're in a 401k plan and you have some cash, make sure and adjust your withholdings so you can maximize your contributions to your IRAs this year. That'll minimize your taxes. Also, if you've had a low income year this year, which many people have because of COVID, they've had time when they were off work, they were on unemployment, this gives you a little opportunity to do some Roth conversions of your IRAs. What this will do is it'll move money from your regular IRA to your Roth. Now that'll be a taxable event, but all the growth on that Roth going forward is going to be tax-free. So if you're a ways away from retirement, it's a great opportunity to make a conversion. So I would encourage you to look at that and look with your tax advisor and make sure that that's an appropriate move for you before you do it. But it's a great opportunity that we have to make lemonade out of lemons sometimes. So if you've had lower employment this year, let's take a look at that. Also, make sure you get your contributions in this year for Roth or IRAs as much as you possibly can. Now, the last area I want to talk about is charitable giving. With the tax law change we had a couple of years ago and the increased standard deductions, many people that are charitable, that give a few $1,000s a year, are finding their charitable contributions don't really help them on their taxes. But what we encourage people to do is what we call stacking. And what that means is if you normally give, let's say $10,000 a year, which I know would be very, very charitable, but if you give that much, if you can find a way to give maybe 3 years of income, 3 years of charitable contributions in 1 year, that will give you a $30,000 deduction. This is very advantageous because you'll still get your standard next year. Now, one of the ways you can utilize that is using donor advised funds, which are a way to make the contribution, get the tax deduction, and then send the money to your charity over the course of the next 2 or 3 years. That's an approach that we find is very beneficial from a tax planning standpoint. It doesn't save you tons of dollars, but it does help you utilize the tax code and save a little bit here and there where you can. The other thing you want to look at, if you live in the state of Missouri and you give to a charitable organization that issues Missouri tax credits, make sure and find out about that. The Missouri Tax Credit Code will give up to 70% of a state tax credit, which means if you make a $1,000 contribution to an eligible organization, you'll actually save $700 on your Missouri taxes. Now, some of them are 50% and some of them are lower percentages. Many of these organizations are ones that serve the lower income areas, they serve children, and a variety of people that are in stressful situations in their life. So you might want to take a look at that. You can go to the Missouri Revenue Department website and you'll be able to look up their tax credits there. Or you can call your favorite charities and find out what they have available. That's about what we have this year that we want to talk about tax planning. We have the RMD changes. We have capital gains that you want to address. Address your income for your cost of any Medicare, your retirement plans, and last, your charitable giving. So I hope you guys have a great end of the year. The market in the last couple of weeks has been really pretty amazing. So hopefully we continue that, and the forecasts are that for 2021 we should have another great year. So enjoy it. Have a great holiday with your family. Thank you very much.